welcome to this week's On the Spot, where we discuss what's happening in the freight market over the last week or so. So I'm Zack Strickland. With me, as always, JP Hampstead, Director of Passport Research here at FreightWaves. JP, capacity continues to tighten throughout Labor Day week, and this is not necessarily a traditional pattern. We normally see some tightness around a holiday, and then all of a sudden it kind of comes back online. Over the last 5 days or so, we've still seen tender rejection rates nationally increase significantly. What's your take on all this? Do you think that we're really going to see this sustained capacity tightness, increasing volumes continue?
I do. I think there are a couple of reasons why capacity is really tight. I think that there's a lot of demand for truckload capacity from the nation's largest retailers that are running at fairly low inventories and have fairly high sales. You're seeing that show up in port volumes, and the Wall Street Journal is reported on that, and things of that nature. The industrial economy is starting to recover, starting to come off the bottom. I mean, automotive is probably the most robust part of the industrial economy right now, where OEMs are kind of making up for lost time. Oil and gas is probably the weakest. But on the supply side, I just think that there are some sort of developments that we're still working through that are causing enterprise carriers to really have trouble seating their trucks the way they want to. And we talked about the Drug and Alcohol Clearinghouse. We've talked about the limited operations of the country's driver schools,
right,
and a couple other things like that. Used truck orders, all of that. It will take many months to work through, and so I just think that the rate at which new capacity can be brought into the industry may be a little bit slower than even the last cycle.
You think that, in 2018, that's kind of the last big market disruption that we have to compare something on this scale to, even though they're very different events. We've discussed that at length. Yeah. Do you think that, after the 2017-18, explosion of freight and capacity tightness, we saw a lot of people go out and buy trucks, and start just adding capacity en masse to the market? Do you think that there's, what level do you think that we'll hit that compares to that?
That's a good question. I mean, capacity is coming back. We've seen it show up in the employment data. We've seen it show up in insurance policies. We've seen it show up in numbers like Landstar BCOs, new truck orders, etc. Even the firming up of asset prices in the used truck market suggests that people are, trying to take advantage of this market. I just think that the volumes are so high, demand is so high relative to capacity, and there are so many barriers to entry that it's just going to take a while. I definitely think that this is not a new normal.
Right.
No. Like trucking tends to be a boom and bust industry that self-corrects with pricing.
Yep.
It's an almost perfectly competitive, quite efficient market in that way. So at some point there will be a correction, but honestly, with the way that the industrial economy is starting to support volumes, I don't see capacity catching up to demand anytime soon. I mean, demand is still growing.
Yeah. So, we were talking to Dr. Zack this week on our Freightonomics podcast. He's one of the contributors to the Logistics Managers Index. They measure warehousing capacity, trucking capacity, inventory levels, all sorts of stuff, really focused on the logistics space. And one of the things that we asked him, what did he think was going to happen in this fourth quarter? Because we're already at peak levels, and they continue to kind of climb higher, even though we appear to have some level of resistance. Carriers are trying to accept as much freight as they can, but at a certain level, and there's this resistance. So fourth quarter comes around, we've got all this inventory piled up in the warehouses, and then we have retail peak. He basically said he thinks that the retail peak is going to be absorbed by what's already happening. We're already seeing e-commerce booming. We're already seeing a lot of in-house orders, and he thought that, there may be some sort of hump but it's not going to be like a double down effect where we're going to see tender rejection rates say to 50%, spot market rates go to $5 a mile, et cetera. What do you think about that?
That might be right, and certainly I think both retailers and carriers would prefer that scenario. And so when you look at the way that UPS announced that they were adding 100,000 workers for peak, right? But they're doing that essentially a month earlier than they normally would. It's the same number of workers. Mm-hmm. They're hiring them for starting a month earlier, trying to kind of flatten the curve in a way, to mix our metaphors. And I think also that e-commerce retailers are thinking about doing sales and promotions much earlier. I mean, when you think about the way that they sell their goods, it doesn't have to do with people's like physical habits of like being like, oh, it's the week before Christmas, I need to like go to Target or whatever. It's like they're promoting ads and links to specific items in people's social media feeds on their phones. They're paying for things to move up the Amazon rankings in certain ways that are keyed to their current inventory levels and which things they want to move when.
Right.
And so, the idea, is that e-commerce retailers are going to try to make it a little bit easier on themselves, and that parcel integrators and by extension truckload carriers may have a little bit of a smoother ramp instead of a sort of a violent spike in demand.
Yeah, I like that. To me, my thought is, I think we're already in this e-commerce boom. Retail has already pretty much come back. We've already seen kind of this surge. I think the home goods thing will diminish as we get into the colder months. The Home Depots and Lowe's will have their off-season more so than they will. So certain things will pull back, but we'll definitely see some ramping in other spaces. That industrial sector, though, to me, is the one that's going to be the telltale sign of whether or not we do see the hump, because carriers are already experiencing tons of CPG, food and beverage, all that kind of stuff. Food and beverage will probably, pull back somewhat. Produce was tremendous this year. So that's going to start to come back offline. But at the same time, it depends on the ramping of that industrial sector, because that is a lot of your cold season freight movement that occurs.
We're already seeing signs of life in the industrial sector, even in oil and gas. And it's interesting because there are different ways to look at the level of activity in oil and gas. Mm-hmm. For a long time, what people looked at to sort of predict or get ahead of growth in oil production was the Baker Hughes rig count, which is just the count of oil rigs that are actively drilling new wells and looking for oil. Right, and that has been suppressed for a long time. It really bottomed like last month, and we haven't really come off the bottom in terms of new wells. The issue with just looking at the Baker Hughes rig count, though, is that there are more than 3,000 drilled but uncompleted wells in the Permian Basin alone. So they're not, so what really matters, what you can actually look at is a completely different data set, which is the Primary Vision frac spread count, which is like essentially after you've drilled it and completed it, it hasn't been fractured. The frac spreads are the assemblages of equipment and people and materials that then finish those wells, and that has actually doubled off the bottom. So there's one way of thinking about it where the shale producers are actually starting to exploit these drilled uncompleted wells and turn that inventory over. Maybe they're not looking for new wells, but production is coming off the bottom. And so, we're definitely keeping our eye on that. That's a weekly number that we reported on at the beginning of this week in one of our special topics at Passport. So, I just think that chemicals kind of follows oil and gas, which is a huge international trade thing between the U.S., Canada, and Mexico.
Well, the chemicals are used to, process the, crude.
Yeah, well, that and you make propane out of natural gas. Yep. You make polypropylene, which is plastic, out of propane. You make other things out of plastic.
And plastics, of course, everybody knows, are a big part of our economy.
Makes the world go round, right? So we're looking at it very carefully, and I think there are some older metrics that are probably less relevant to how the oil and gas economy works now, and we're trying to kind of get a holistic view by comparing lots of different cuts at the data.
Right.
But we're pretty optimistic, honestly, about the industrial sector.
Right on. So we've discussed a few of our underlying items, the things that kind of drive freight in the long run, the industrial economy, et cetera. Employment levels are, of course, important.
By the way, I wanted to ask you a question about the employment levels, because I see this on like LinkedIn and on the internet and social media talked about a lot.
Yeah.
Does the BLS, the Bureau of Labor Statistics data, include owner-operators? I don't think they do. They're not on payrolls.
That's a great question for Anthony Smith.
Okay, because I was looking at it and I
would think that they would.
Okay, you think they do?
Yeah, I think they do because of the way that they have to, if they're not looking for employment, because the way that the survey works is that it's somebody that's actively looking for employment or, willing to work. And then they have, of course, tax records that show people that are not looking for employment.
Okay.
Yeah.
Well, that's Anthony Smith, because I looked at it and I thought it excluded people who were self-employed. But we'll ask the economist. We need
to ask the economist on that one. But
that's a good question, though.
These are good questions. Of course, I talked to Anthony this week about the permanently unemployed versus the temporarily unemployed, which they're starting to track now, which is a much better representation. And we are starting to see that permanently employed number kind of hold firm. In place a little bit more, so that's concerning in the long run. Today, it's not as important, especially now we've got another extension on the government stimulus for another few weeks. So that's going to keep these, hourly workers and the lower wage workers still engaged with the economy. They're still spending. I think we'll get another bill eventually once Congress figures that out. But
I think so, before the election?
More than likely. I think we all know. But let's hit the freight market real fast as we have a few minutes left. We are seeing a few things, in the underlying fundamentals of the dynamics of the freight market. We've been talking, about how the volumes have really created a capacity issue, et cetera. But the West Coast predominantly driving a lot of the freight market tightness, Los Angeles, of course, being at the center of all that. What we're seeing now is Los Angeles, even though we're still seeing very tight capacity out there, over the last week or so, spot rates have come down a little bit. Tender rejection rates came down and then kind of flatlined around 27%, out on the West Coast in Los Angeles. So in the meantime, on the East Coast, we're watching markets like Harrisburg, Allentown, and all the Northeastern corridor really see a huge increase in tender rejection rates, but also markets just along the East Coast in general.
Right.
Tightness show up there as, my thought is that a lot of the carriers figured out they could get to Los Angeles and get these high rates, and now it's starting to show up as supply is kind of
for sure. To get I feel like to get a meaningful shift in like national capacity from one region to another, it takes like a kind of a month-long, well-known narrative to percolate through the market. And once that information is acted on, then things kind of adjust. One market I did want to highlight though is Chicago, right, which is also tightening up a lot, maybe due to carriers' response to anticipated high volumes out of Los Angeles. Tender rejections in Chicago are now over 20%. Last week, Chicago to Atlanta spot rates broke above the national average, which I thought was really surprising because Chicago to Atlanta is a lane where
it's like the Dow Jones Industrial Index. It's like
there's tons of small carriers
benchmark.
Based in Chicagoland. It's a very dense lane. It's depending on where you're starting and where you're ending from. It's around 700 miles, which if you have a strong solo, you can do in a day. So it's an easy to cover, dense lane, and brokers have all these natural advantages on that lane, and they usually keep the spot rates fairly suppressed on that lane below the national average.
Right.
It went up 10.5% last week, breaking it, like I said, above the national average, I think to like $2.93 a mile. And that just kind of tells me that like if Chicago to Atlanta is above the national average, brokers have like lost any control they had left over the spot market.
Yeah,
right. This is like their kind of their home base, right? There's
a huge amount of people domiciled up there. You have the same thing down in Atlanta. These are population centers, so that lane right there controls a lot of the directionality of the, north and south and, south to north. You have a ton of freight moving in that lane. It's also a heavy rail lane. So yeah, I think that's a good point that you're making, that, if brokers have lost their control of the pricing and what should be one of the more stable, steadily supplied markets.
That's a lane that, like, they don't even look at DAT on, right? Because they
Right.
kind of know the rate in their sleep.
Exactly. But if they're having trouble covering Chicago to Atlanta, which is a bread and butter lane, they're having trouble covering just about anything at this point.
Yeah.
So well said. Well, that'll do it for this week's On the Spot. Thank you so much for watching, and stay tuned to FreightWaves.com for any future freight market updates. Have a great week.